Good morning. Today I'm going to discuss about the debt management and how the various provisions of debt management is basically discussed in more theoretical and an empirical perspective. Normally, the debt management guidelines were given by the World Bank and IMF to manage the sovereign debt. That is all about the conceptualization portion and why this has been essentially treated these days very important and whether debt this is also addresses the issue of debt through credits, public borrowings and price level, etc. Basically the principles of debt management in a nutshell. So sound risk management practices is essential given that a government's debt portfolio is usually the largest financial portfolio in the country and can contain complex and risky financial structure which have the potential to generate substantial risk to the government balance sheet and overall financial stability. This is actually the kind of revised guidelines for public debt management in 2014, which was enshrined, and the report was being produced by World Bank and IMF, and they have actually attributed some of the aspect of this debt management in that context, and they try to articulate the fact that there are theoretical propositions as well as an empirical founding that why should we have managed. And this is also interesting to keep in mind that in 2011 the sovereign debt crisis was all over the Europe, and in that context, this becomes a very prominent subject discussion ever since, and that is why in 14 there is a there is a revised manual, in fact, that is discussed about the uh, case. And the first part focus on the asset liability management. If we look into the IMF guidelines, in fact, and the second part was on this why we have debt management to smoothen the income part, that is nothing but the tax part, and these are actually the kind of setup one can find out from the observations and the propositions of the IMF World Bank. And there are different countries in that context been placing their interest of debt management in that context, and mostly the RBI and basically the RBA and other kind agencies, in fact, give. So let us look into the debt management objectives and coordination in that context. So objectives of the case is actually the main purpose, and it is ensures that the government financing need and its payment obligations are met at the lowest possible cost over the medium long, consistent with a prudent degree of risk in that. So whether you are borrowing for a long term or a medium term has to be managed in that context. So the scope of this particular presentation in that sense of debt management is basically should encompass the main financial obligation over which the central government exercises control. And then also it talks about the transparency aspect of debt financing, and where the clarity of rules, responsibility, and objective financial agency responsible for debt management is done with open process formulating and reporting of debt management and policy being discussed, public availability of information in debt management policies, accountability and assurance of integrity by agency responsible for debt management, etc., being discussed. And then the report talks about, actually the guidelines talks about institutional framework, how can we manage it, and through better governance, management of internal operations, and other things. Then coming to the debt management strategy are concerned, these guidelines try to give a variety of points which we will discuss in detail, and finally the risk management framework and how we can actually adopt it, and where it has been applied, so especially active management or contingent liability, etc. And the final point, which again the guidelines discuss, uh, is a development and maintenance of efficient market government securities. So why all this debt management is actually to the idea of inculcate the idea of facilitating the basically the market economy, and as we have seen, the intervention of government is being treated as a kind of a failure, or the presence of public good, or the existence of government is normally being treated as actually the failure of the market in that sense. So um, and of course the modern corporations in that sense is also having an equal kind of a footing of the market failure of the two-party kind, where the modern corporate entities normally act as not a two-party, it is a third party, it's itself an institutional entity, or a legal entity. In that sense, it is also act as a corporation. So the modern understanding or narrative of the market equating with the corporate houses and the interest of the capital is also kind of a parallel government for myself. So at least in my concern, this is also equally been driven out when we speak purely in terms of market mechanism in that context. So let us look into the details, and needless to say that we are not going to the details of that. What we are going to focus today is actually on the management strategy guidelines, etc., which was laid by the World Bank and IMF in that context of debt management. And let us look at the first objective of it. The main objective of the public debt management is to ensure that the government's financing needs and its payment obligations are met at the lowest possible cost over the medium to long run, consistent with the prudent degree. Now, as in the outset, somebody can say that actually there are varied debt, what do you call, the debt profile of different countries. For instance, a country like Japan, having a highest, one of the highest debt proportion in 2021, consisting of around 256% of the total economy is under debt. So the kind of debt, that means if you produce 1 rupee, you are actually indebted to 2.56 rupee in that context. So this is a kind of a level of debt which Japan is having, which is a developed country, whereas United States is not actually half of it. In fact, half of the debt of the Japan. Whereas the countries like India, if you look into, then we have something around 92 to 93% in the overall liability, debt and liability, public, internal, external, and the other liability coming together. That is in 2022, March data set says that it is almost 135 trillion rupees is actually the total liability of the government, that is in both internal, external, and other liabilities. So together, now if you have actually around 145 trillion as your GDP, then this is roughly around 93% or 92 to 93% in a conservative estimate one can go for it. So in that sense, a huge debt, that is, we are still actually not in the trap of debt of 1:1, where in the developed, advanced developed countries as well as the poorest countries like Sudan and other countries also having a highest debt. Whereas the highly developed economies like Brunei, for instance, having autocratic government and all, having actually very, very smaller debt GDP ratio, which is less than almost 2%. Of its total GDP is only the debt in that sense. So we know that the extravaganza of the Sultan of Brunei and all are discussed. But at the same time, look at the GDP debt ratio, debt GDP ratio see these countries are not. So it is needless to say that actually, if you are looking into the aspect of debt and all, there is a varied profile one can actually see. At the same time, our neighbor Sri Lanka is now burning because of a debt crisis in that sense. So Greece had actually fell into the grips of this debt trap, sovereign debt crisis in early 2010, 11, and you have other countries, Spain, Italy, and many more countries in the European case, which is all fall prey to the debt trap in that sense. So in that broad context, totally, it has been placed that the management of debt is very important. But at the same time, I have also said that sometime the correlation between the development with that of ended development makes no sense of the debt itself. So, but still, it would be always advisable to say that actually, if you have a very sound base, that would be better always, and that's the kind of a thing which is somebody has to spoke about. So the sovereign debt is basically has to make a check and balance in that sense, and prudent risk management to avoid dangerous debt structure and strategy is crucial given the severe macroeconomic consequences, severe sovereign debt default, and the magnitude of ensuing output losses. These costs include business and banking insolvencies, as well as the diminished long-term credibility and capacity of the government to mobilize domestic and foreign savings. Both one that is actually to when I say this, it is also important to remember the origin of the sovereign debt also in the context of 2008 the world crisis context, because most United States debt trap had increased, or the debt burden has increased because of the bailout plans which it has actually given, or because of getting out of the crisis in that sense. So the public debt is basically being owned in the United States and many of the European countries is to basically get out of the bubble burst, in fact, which was a result of the business cycle itself. So in that context, it is also a kind of a crocodile tail one can crocodile tear one can just simply have this in a peripheral sense of dealing with the debt. But that is why I said, we should be very careful making a statement of this kind. And let's come to the scope of this thing. Again, it is also important that management should encompass the main financial obligation over which the central government exercises control. These obligations typically include both marketable debt and non-marketable debt, such as concessional financing obtained from bilateral and multilateral official sources in a number of countries to scope of the debt management in that sense. So, what are the risks encountered in the sovereign debt management is also immediate question somebody can ask actually. So there are so many varieties of risk involved in the case. Some of the risk we need to really look into, that is the market risk, rollover risk, liquidity risk, credit risk, and settlement risk, operational risk, etc. If somebody want to actually look into the details of those risks, the capsule version of IMF report is talks about this is in a very lengthy manner. Due to the paucity of discussion time, I'm actually skipping, and you can refer the guidelines of the IMF, which I will share in the end of the lecture as a link. So the domestic and foreign currency borrowings are now typically coordinated as part of the scope of it. And moreover, debt management often encompasses the oversight of liquid financial asset and potential exposure due to off-balance sheet claims on the central government, including contingent liability such as state guarantee in that context. So, in establishing the implementing a strategy for managing the central government's debt in order to achieve its cost and risk objective and any other sovereign debt management goals, the central government should monitor and review the potential exposure that may arise from guaranteeing the debt of subcentral governments and state-owned enterprises, and whatever possible be aware of the overall financial position of the public and private sector borrowings in that sense. So this is how the scope can be actually articulated, whereas the coordination with the monetary and fiscal policy is also deemed to be important. And debt management in that context, fiscal policy advisors and central bankers should share an understanding of the objective of the debt management. Fiscal and monetary policy, given the interdependency between their different policy instruments, debt managers should convey to fiscal authorities their views on the cost and risks associated with the government financing requirement and the debt level. This is essentially very important, because unlike in the macroeconomic perspective, where normally we distinctively understand the fiscal and monetary policy and we deal with it separately. But if you look into the economies like India or mixed economy, which is the characteristics of the most of the world economy, where you can say that most of the time the interaction between the fiscal as well as the monetary policy is a spiraling one, rather than it is distinctively separate in that sense. Because the monetary policy and the fiscal policy is actually corroborates each other rather than compete each other in the context. So, in the modern understanding of the statecraft and public management, this is also very important to basically emphasize on, and therefore the credibility of the public debt management makes sense in that sense. So, which is in toto has to be dealt with the monetary as well as the fiscal policy realm, and we cannot see it is optimistically the fiscal policy vis-a-vis the monetary policy, which was the context and theory which is normally being discussed. But what public economics addresses is actually a kind of a mix in that sense. Okay, so then the question of where the level of financial development allows, there should be a separation of debt management and monetary policy objectives and accountability comes in. The clarity, that means the clarity in rules and objectives, the debt management and monetary policy minimize the potential conflict, therefore. And then comes the issue of debt management, fiscal and monetary authority should share information of government's current and future liquidity needs in that sense. So you cannot actually go and borrow whatever money which you want, and that the government can do, because the government as an entity is having more stable than an individual who go and get money in that context. But it doesn't, needless to say that the government is not supposed to actually borrow there. That is why there is a prudent bar for borrowing being educated to the governments or whatever governments. So that is very, very important, and debt management of fiscal and monetary authority should share information on the government's current and future liquidity assets, their needs, therefore. And that is why it is important, because you can't go and borrow unnecessarily. Now, if it is actually for developmental expenditure, if it is for the drive of the economy to move from state A to B, well, this is always possible, and but not for extravagance. And we know that in the world, the extravagant borrowings of the governments had actually overthrown the governments in that sense. Whether you look into the context of JAR, or whether you look into the context of the French Revolution, the pre-revolution France, or the nobility, or wherever you look into it, and you cannot, the king or the state cannot act optimistically and authoritarian kind of an attitude they cannot keep. And if that is the case, then this happens, and even you can't actually simply put a lot of burden on people also. Then also people will overthrow the government in that sense. So this is also comes with the mix of this transparency as well as a kind of need which demands that why you are basically borrowing for, and prudence should be in that context. And this is what is in a nutshell IMF and World Bank try to articulate. But the problem is that while they're advocating it, they're also telling that the government has to get out of spending of whatever they're ilk a kind of a theoretical framework where the importance of intervention of the government is essential in an economy like or mostly developing economies of India or elsewhere. That context, there the importance of the state is very important, and therefore apparently their borrowings. And so the transparency and accountability part of this is essentially should be kept in, and the the code of good practices on transparency in monetary and financial policy, declaration of the principle, uh, can be maintained, no problem, and which will clarify the role, the responsibility, and objective financial agencies responsible for debt management. That is the allocation of the responsibility when the Ministry of Finance, the central bank, or a separation of debt management agency for debt management policy advices and for undertaking primary debt issue, secondary market arrangement, depository facilities, and clearing and settling arrangements for trading government security should be publicly disclosed in that sense. And it is also equally important that the objective of the debt management should be clearly defined and publicly disclosed, and measure of cost and risk that are adopted should be explained, because it is essential. Otherwise, the burden of this is going to befall on the people, where they are not aware of what kind of demon is going to come out. So this another problem with the transparency is actually the open process of formulating and reporting debt management policy. So in that materially important aspect of debt management operation should be publicly disclosed, as we said. And again, the regulation procedure of the primary distribution of government securities, including the auction formation, rules of participation, bidding, allocation, should be clear to all participants. This is also interesting because in the case of Kerala, we had the Masala Bound case, and which will be, this the security, the stocks were being registered in the London Stock Exchange, etc. is so in the news, and the return, the payment, the kind of process, etc., should be actually publicly being disclosed. So that is what is actually the whole point. And public availability of information debt management policy, therefore, warrants that the public should be provided with information on the past, current, project, budgetary activity, including the financing, the consolidated finance position of the government, etc. So the government should regularly publish information about the stock and composition of its debt and financial asset, including their currency, maturity and interest rates, security, etc. And debt management activity, again, a third point somebody can think of is accountability and assurance of the integrity of by agency is responsible for debt management. And for that, the respective government has to formulate institutional frameworks such as governance. The first point is governance. How can we smoothen the government and governance? The legal framework should clarify the authority of borrow and to issue new debt, invest and undertake transparency on the government's behalf in that sense. And the organizational framework for debt management should be well specified and ensure that mandate and rules are well articulated in the government's record in that sense. Again, when you talk about management of internal operation, again you have to keep certain things in mind, that the risk of government loses from inadequate operational control should be managed according to the sound business practices, including well-articulated responsibilities for staff and clear monitoring and control policy and reporting arrangements made. And again, if you look into the debt management activity should be supported by an accurate and a comprehensive management information system with the proper safeguard. That is also essential. Whatever information which you're collecting has to be kept and guarded. And Again, the debt management should be subject to a code of conduct and conflict of interest guidelines regarding the management of their personal financial affair. And the procedure should be in place to mitigate the risk and that a debt management activity might be severely disruptive by nature of disaster, social unrest, or act of terrorism, etc. Now, what are the strategies one can adopt for this? Is the risk inherited in the government's debt structure should be carefully monitored and evaluated, and these risks should be mitigated to the extent feasible by modifying the debt structure, taking into account of code which was given by institutions. Some of the pitfall of debt management can be seen. See, the increasing the vulnerability of government's financial position by increasing risk, even though it may lead to lower cost and a lower deficit in the short run. Debt managers should avoid exposing their portfolio to risk of large or catastrophic losses, even with low probability, in an effort to capture marginal cost saving that would appear to be relatively low risk in that sense. And maturity structure also has to be looked into. Excessive unhedged foreign exchange exposure should be checked by the people who are managing this debt, and debt with the embedded put options. Again, if you look into the implicit contingency liability, then that is also an important issue. If you look into the debt management practice that distorts private versus government decision, as well as understand the true internal interest cost, again, also part of the pitfall of this thing. Then you have a variety of other issues, which is the misreporting of contingent or guaranteed debt liabilities comes up in the way, and the use of non-market financing channels comes up as a pitfall, and improper oversight and recording of debt contracting and payment and debt holders or the debt holders. These are the issues comes up while somebody talks about what is going to happen about the debt management case. But what are the basis of this stylized case in which one can basically look into? See, once you want to basically conceptualize a balance sheet, the debt balance sheet has to be examined. What is a debt balance sheet? An asset liability and a shareholder's equity at a specific point in time. The asset, what the bank owns or funded by the liability. In this case, government. Okay, what the bank owes and the equity, what the owners or financing, etc. in that sense. So, what is actually gives in a nutshell is that the government, the source of repayment, the source of non-repay, that is no source of non-repayment kind of thing can be easily understandable if you have a balance sheet in that context. So this is very essential. So when you talk about the conceptual asset liability management, a balance sheet, a summary of the financial balancing of the company, same is actually the case with the government in that context. So the balance sheet can be considered as a snapshot of the company's financial case. So if you look into the Indian debt case scenario, there are varied data point one can actually get. So if you look into the public debt or of India, you won't get actually exact figures unless if you look into the exact point where you want to get it. So the external debt is around 21% of the total GDP in that sense. But it is also varies because once the rupee value falls, then the possibility of our debt increasing will go up. So similarly, if your rupee is get depreciated in terms appreciated in terms of the other thing, then possibly your debt can also actually the external debt can show a fall, but the reverse can also be the truth. If you look the whole trajectory in an exchange paradigm. Now, if you look into the internal debt statistics, you will see that roughly you have some 57% as the internal debt, uh, which constitute all kinds of borrowings of small savings, etc., which bonds and debentures, which is actually being produced by the government to finance. So all this basically comes under the internal debt of the state, and if you combinedly put it, you still get only 79% hardly. But there are other liabilities, outstanding liabilities of the government, that is accumulated liabilities over a period, and this has also been always put part of it, and that is why in the receipt budget to the government, this figure of 135 plus 135.83 trillion been marked as actually the outstanding public debt as well as liabilities of the government. So this is comes around roughly, if you have a projected in 2013, sorry, 2022 March projected GDP is actually 147, then with a conservative figure of 92% of the total is actually the public debt. Now, this data gives a kind of a picture, just like as I said in the asset liability case. This is what is actually the country's liability. But if you look into the source of financing in different form, then it is also the growth is actually higher than